When it comes to financial scams, fraudsters will go to extreme lengths to exploit your trust. From affinity fraud to promissory notes, these schemes cost Americans billions of dollars each year. Investors should stay informed about the latest scams to avoid losing money. Here are some of the top 10 biggest financial scams to watch out for. 1. Ponzi scam. Ponzi schemes are a type of investment fraud where new investors are paid fake returns using money from older ones. Named after 1920s swindler Charles Ponzi, this scam relies on word of mouth to attract new investors. Investors are often lured in by promises of high returns with little or no risk. However, remember that all investments carry some level of risk, so be suspicious of any investment that claims to offer a high return with no risks at all. Other common Ponzi schemes include advance fee fraud, also known as boiler room scams, pump and dump schemes, and pyramid schemes. These scams use short-term promissory notes that are typically not registered with the Securities and Exchange Commission. The promoter uses these notes to attract investors and then disappears with the funds, leaving investors with worthless investments. Also, the promoters often spend the investments they receive for their own personal expenses, depleting the funds and speeding up the scheme's collapse. 2. Waste management scam. The waste management scam is one of the biggest financial scandals in the world. The company's founder Dean Buntrock and other executives cooked the company's financial statements to inflate profits. The fraud resulted in the largest restatement of earnings in corporate history. Investors lost billions when the fraud came to light. The fraud at Waste Management involved numerous schemes. One of the most egregious involved manipulating depreciation expenses for the company's assets, including garbage trucks. Management inflated salvage values and extended the useful lives of the trucks to avoid depreciation costs. The fraud was enabled by an internal culture of dishonesty and manipulation. Several of the company's managers were former Arthur Andersen employees, a firm that had been forced to pay the largest civil penalty levied against an accounting firm for its role in the Enron fiasco. '3. Enron scam. The Enron scandal was one of the biggest financial scams in history. The company collapsed in 2001, and many people lost their retirement accounts and jobs as a result of the fraud. The scandal also led to new regulations and laws, including the Sarbanes-Oxley Act. Several executives, including Kenneth Lay, Jeffrey Skilling, and Andrew Fastow, were charged with crimes such as fraud and insider trading. Enron used a series of accounting tricks to hide debt and inflate profits. These included mark-to-market accounting, special-purpose entities, and round-tripping. For example, the company would record a loan as revenue just before quarterly earnings reports. This practice allowed Enron to report enormous profits even though it was going bankrupt. It was ultimately caught when Sharon Watkins blew the whistle on internal accounting fraud. This led to the bankruptcy of the company and the dissolution of Arthur Andersen. 4. WorldCom scam. In one of the biggest accounting scandals in US history, WorldCom engaged in fraudulent practices to make themselves look more profitable than they were. The company was founded in 1983 as long-distance discount service and became a global telecom giant with an impressive market capitalization of $186 billion during the dot-com boom. As the tech bubble burst, revenue dropped and expenses rose, putting the company in dire financial straits. To cover up their losses, executives inflated profits by capitalizing expenses and transferring them to the books, which resulted in billions of dollars in earnings that were never earned. The fraud was uncovered when an internal audit team began looking at WorldCom's assets and stumbled upon an account titled Prepaid Capacity. This led to the discovery of massive accounting fraud that eventually cost the company $11 billion in lost income. 5. Theranos scam. Theranos was a startup company that promised to revolutionize healthcare with a device that could run multiple tests using only one drop of blood. The company grew rapidly and raised billions from investors including the Walmart family, media mogul Rupert Murdoch, and former U.S. Secretary of State George Shultz. The company's faulty testing machine, the Edison, was revealed to be unreliable in 2015 when a Wall Street Journal investigation exposed the problems with the device. Many patients were misdiagnosed because of inaccurate results. Theranos' founder, Elizabeth Holmes, and her number 2, Ramesh Balwani, lied to investors and business partners about the Edison's performance and financial status. Both whistleblowers, Erica Chung and Tyler Schultz, were punished by the company for their efforts. Chung was fired and threatened with legal action by Theranos' high-profile lawyer. She later quit the company in disillusionment. 6. Wells Fargo scam. Fraudsters send unsolicited text messages to people claiming their bank account has been locked. The vague, unclear message stirs up curiosity and entices victims to call the scammer on the phone. Once on the phone, fraudsters pressure victims into sharing personal information and coerce them to make transactions in order to reverse charges on their accounts. These funds end up going directly to the crooks. The fraudsters often spoof official Wells Fargo shortcodes in their text messages. They may also include shortened or mangled link URLs that redirect to bogus websites that steal personal information or upload malware onto your computer. Typos, poor grammar, and odd formatting are other clues that the text is a scam. Avoid clicking on any links in unsolicited messages. Instead, visit your bank's website or app to check on suspicious activity. 7. ABG Shipyard scam. India's largest shipbuilder, ABG Shipyard, was involved in a massive banking scam that affected 28 banks. The company allegedly diverted bank loans into overseas subsidiaries and related parties over a 6-year period. During this time, the company manipulated its accounts by inflating assets and not disclosing liabilities. This allowed the company to obtain additional loans. Eventually, the company collapsed and was declared an NPA in 2016. The CBI has filed a first information report against ABG Shipyard and its executives. They have been accused of defrauding the banks to the tune of $2,842 million. The scandal has exposed a number of problems in India's banking system, including poor risk assessment, lack of supervision, and inadequate recovery mechanisms. It has also hurt the reputation of ABG Shipyard's clients. Many of them were forced to cancel orders for Navy ships. 8. Zinger scam. Zynga's social game platform lets gamers run a virtual mob or build their dream farm. They pay for chips that are then used in the games, but a black market in cut-price chips has developed. A New Zealand woman was scammed out of $60,000 in Zynga's Words with Friends. She complained on the game's online forum and warned others. Scammers are also targeting players by posing as lonely widows or oil rig workers in foreign countries. Back in 2009, tech blog TechCrunch hammered on Zynga for making money off its game players through offers marketing. In a series of blog posts, Fred Wilson, the Union Square Ventures VC that invested in Zynga, defended the company, saying the whole controversy was a load of BS. He claimed that Zynga made most of its revenue from the sale of virtual goods to gamers. 9. Cryptocurrency scam. Cryptocurrency scams are designed to take the victim's money. They are often marketed with fake celebrity endorsements, get-rich-quick claims, and fraudulent platform investment opportunities. Scammers can target victims through a variety of methods, including social media and dating apps to establish trust with individuals. Once they have the victim's confidence, scammers introduce a cryptocurrency investment opportunity. Legitimate cryptocurrencies publish thorough disclosures, known as white papers, before they launch. A well-written white paper includes information about the cryptocurrency's blockchain, describes its protocols and formulas, and clearly explains how the coin or token will function in the ecosystem. Scammers will also request payment in cryptocurrency or demand that the victim reveal their private keys. They may use phishing websites or e-transfers to steal the user's cryptocurrency. These forms of payment are hard to trace. They can also be used to hide fraudulent transactions from law enforcement. 10. Identity theft scam. Whether from online shopping, prize and sweepstakes scams or investment scheming, identity theft is one of the biggest financial scams in the world. Last year, 2.4 million consumers filed fraud reports to the FTC's Consumer Sentinel network on identity-related issues. These scams often begin with unsolicited calls, emails or text messages that mimic recognizable domains and impersonate familiar contacts to trick victims into sharing personal information or sending money. Red flags to look out for include requests for gift cards, cryptocurrency or wire transfers. You've worked hard to build your savings and pursue your financial goals. Protecting what you've built requires vigilance and strong security measures, including using two-factor authentication on your bank accounts. You also need to stay aware of new threats as they emerge. Scammers are always coming up with creative ways to rob people of their hard-earned money.